And we're going to talk about option smiles. Now, this is as retarded as it sounds, but I need you to do something, and this is very important. Nothing else matters than what you are looking at on the screen. As soon as those questions start coming into your head about, oh, what's this mean? What's that mean? None of that shit matters because, first of all, this market that we're in, nothing of the sorts has ever happened before, obviously. So you cannot compare this with the past. And again, as far as how the shit works, we're going to be talking about implied volatility. Just hear me out and look at what I'm showing you because I am not a genius. I am not intelligent by any means as far as from a financial standpoint. However, I have spent an autistic amount of time looking with my own eyes at things, determining and defining them as I see them, which I feel is important. Because F everything else, fuck everything else. You're not going to tell me what something is and how it works when you've looked at it piss amount of time compared to the next person or myself included. Now, again, the situation has never happened. So I'm about to show you what I know based on what have seen versus what is going on right now, and then the literature that's behind it as far as a historic viewpoint. Because again, the market evolves over time. Definitions change all the time. So smile, put your smile on. So first of all, what the hell is an option smile? We'll get into it. So here's some key takeaways as defined by Investopedia. With just in this definition alone, I disagree with some points, but this is just the basic Options 101 definition of IV. Key takeaways. Implied volatility is the market's forecast of a likely movement in a security's price. I disagree with this. IV is often used to price options. This one I agree with highly. Where high implied volatility results in options with higher premiums and vice versa. This is the one that I live by so far. Supply and demand and time value are major determining factors for calculating implied volatility. This one I also agree with. Implied volatility usually increases in bearish markets and decreases when the market is bullish. This I also agree with. So the first one, don't agree with that one because that goes against everything else we're about to use this for. Now, although IV helps quantify market sentiment and uncertainty, it is based solely on prices rather than fundamentals. This I also highly disagree with. And this is not the same as historic volatility, by the way. Two completely different effing things. So don't bring anything else into this other than what I'm saying right here. Implied volatility, from this definition, we're only going to think about it in three forms. Number one, it's used to price options. Number two, supply, demand, and value, as far as time value, are major factors. And three, volatility usually increases in bearish markets and decreases when the market is bullish. And we're going to disagree with the top two. No, I'm sorry, the top one and the bottom one. Because I strongly believe, which I'm about to show you, that IV helps quantify fundamentals as well. So this is an options chain. Now, again, before you get all confused with all the numbers on the screen, and trust me, I know how easy it is. I've been there. We're only going to focus on what matters. So let's take a lot of this shit off the screen real quick. God, I always forget the freaking morph, man. I always forget it. Every time, without fail. Jeez Louise. Okay, so I'm just going to go ahead and redo that because it was supposed to be like a little bit better looking. Oh boy. Pays being retarded, man. This is an options chain. This is the area we're going to be focusing on, the implied volatility. However, we're going to be focusing on it on both sides because, again, there is calls and puts. However, the IV should be the same on call side strike. So, for example, the 90 IV will be the same on both sides. Now, that's besides the point. We need to look at both sides because although the IV is the same on both sides, there is a slight difference. And again, I'm going to go ahead and clear everything off the screen other than what you need to look at. Don't need that. Don't need that. this is all we need to look at. We have the IV on the call side right here, IV on the put side right here, and then the strike price. Now, again, you may be saying, well, these are the same numbers, so why you have both? Well, look, some are in the money, some are not. So again, this shaded region here is in the money calls, this shaded region here is in the money puts. That's the thing I want you to pay attention to when we're looking at the IV. So, before I go any further, let me tell you what I know about IV based on what I've observed, read about, and seen for the last 2 years, and what I know about it, and what I know to be normal about it. IV is typically lowest at the money, meaning around the current price. So the 90.89 strike, typically, based on what I've seen, and based on literature and just normal market mechanics, IV is typically lowest at the money. Now, what do we see here in this options chain? This is AMD. I highly recommend going to look at multiple stocks and do what I'm showing you here and just look for this phenomenon. Now, again, IV should be the lowest at the money, but what do we see here? It is not. This is the expiration for the 22nd this week. We see that the IV is lowest at the 93 strike. Now, this is where the out of the money and in the money becomes important, because in the money puts have this phenomenon, right, where the lowest is deep in the money, when that also should not apply. Because what do you see here? IV goes up, right, in the money, keeps going up. The same should happen as soon as you get to out of the money. It should go down to the money, and then once it reaches the money or the current price, once it goes out of the money, it should start going back up again. That's not what we see. We see it in the money, going down, going down, going down, and then we go out of the money, but we're still going down. And we don't get to the lowest point until 93, at which point it starts going back up. That is your smile. That right there. That's why they call it a smile. It's just a little arc, or it's volatility skew, and there's another word for it. Now, what's interesting about this is the literature that I looked up. None of them talk about out of the money call smiles. They all talk about out of the money put smiles, which we do not see here. We see out of the money call smiles. Now, the literature that I'll link in the description below, you can take a read for. I've already linked it in Discord for y'all from Discord. But basically what the literature said is that fundamentals or earnings, tickers that suffered subsequent earnings hits, like bad decreases from bad earnings, would show a put volatility smile out of the money. But what do we see here? We see the exact opposite. And we just had what? Bad earnings for all these companies, like these tech earnings coming up soon. Like Netflix was up 7% today. We killed it today. Now, the question is, did we get lucky, or is this a continuing phenomenon moving forward? I don't know. I believe it could be. Because again, this is very abnormal based on what I've seen this whole time up until now. All of a sudden we have these volatility skews across the tech sector, and maybe others. Again, I haven't looked everywhere. I've only been looking into tech. So again, I highly recommend going to look on your own, because I none of this stuff I would be even explaining to you had I not gone and looked on my own. So again, we see the smile here basically from 90 to 95, the lowest IV out of the money for calls, which means, based on what the definition was at the beginning, lower price, and it could mean more demand at that level. So now what we're going to do is we're going to shift one expiration further. And look, the smile gets even deeper out of the money. Now we're between 95 and 100. Before, we were at 90 and 95. We literally move up about $5 or so. Let's take it an expiration further. We're even further out of the money. The lowest IV here is going to be the 105 mark. So hold on. 105 is the lowest here, right? What's the lowest here? 97. Lowest here is 93. So 93, 97, 105. So, and this was the respective weeks. So we had the 22nd was the first one you looked at, and then we had the week of the FOMC meeting, which was the 29th, and then we had the 8th of August, right? Now, let's go all the way out to 2023, in January. Got a lot smaller, didn't it? But it's still deep, deep, deep out of the money at 165. So, again, I know there's a lot of bear narratives going on around there, but this is abnormal. I suggest you go look at this on your own and look at the options chain, and keep in mind that when you're looking at it, the IV should be lowest at the money, not deep out of the money, especially not that far out. Because let's go look at something like, I don't know, let's do STZ. Let's see what theirs looks like. Again, not as many options, not as liquid, but look, where's the lowest IV here? In the money, or at the money. In the money or at the money. Both, but same for both sides. That's how it should be. And then you see it continuously go up once it's in the money for puts or in the money for calls, or as it goes further out of the money, it should get higher. Now, again, remember, 43, since there's strikes at 40 and 45, these are both technically at the money. So while this IV is the lowest one in the chain, it's because it's at the money. It's how it should be. Now let's go to 58 day. IV still lowest at the money. IV is not lowest out the money here. IV is lowest out of the money here. Wow. So again, maybe this is a market-wide phenomenon because, again, keep in mind, institutional ownership. Maybe that has something to do with it. So let's look STZ13F from Fintel and see what's the wraps there. We know SPY is already like super inflated. It's got like 170 billion assets or something like that. Okay, 88% owned by institutions. That could explain things. Okay, we need something with low institutional ownership. Let's use Alphaquery real quick. Let's go to institutional ownership. Let's query this. Actually, we'll screen for it. Institutional ownership is greater. Let's do less than. Let's do 50%. Google, Tesla, Berkshire. Now, is this correct though? Hold on. Now again, like institutional reporting is a very hard metric to get. Okay, 49.18 there for Tesla. 40 here. It's a big difference. 9% difference. Let's check Tesla out. I know there was one for Tesla because people in the group played it today and they made bank. Okay. Jeez Louise. It's lowest all the way out at 825, man. And that's for this week, too. I'm telling you, I've never seen this. And all I can tell you about, there's no literature on it either. I can't find any literature on it. All I can tell you is this should not happen. IV should be highest at the money, not all the way out here at 825. And it's funny to look at it because most literature says, I mean, these didn't occur. These smiles, guess when they started occurring in the market? Not after 1987, after the crash, when Salomon, the whole thing went down. So if that's when these were created, I mean, following a crash, that makes me think even more that the bear market's over. Because again, I've never seen this. And look at them. Look at them. Right here. Look at the IV, or the percent change from a 80% move. Look, the IV crushed these. Only these. This is what I'm saying right here. They're giving it away right there. That's your smile right here. These negative options, despite the price being up and despite everything else around it going up, these go down, and then the golden nugget must be this strike right here at 820 that has 0% change. What the F? This is all just total theory, by the way. But, I mean, we all made bank today from it, and I'm going to keep doing it until it stops working. So, go look at this shit. Try to find yourself a nice, cheap option out of the money, because you may not get this opportunity again. I mean, I've never bought Microsoft calls and made this much money for that cheap. We all know about Pelosi just buying Nvidia. And there may be put smiles that do exist out of the money. You just need to go look for it. But yeah, Microsoft here has lowest IV at 2907, but I'm playing for the 29th. So the 29th is a different story. Lowest IV is about 287.5. So I'll go look at it because, again, that is strange. When the stock doesn't move, that was with Tesla, man. Did anything else trade sideways today? What did Apple do? 67. Look, and these, the lowest IV are the only ones that moved. The ones out of the money went up. I mean, that doesn't make sense, man. It really doesn't. With intrinsic value in the money, these should have some value. But, I mean, there was no volume. That could be why. But, jeez Louise. Money could be made here. So option smile to recoup what it is. It's basically an arc in the volatility that is basically out of the money for calls. I mean, if you find it on put side, same thing applies, just reverse logic. But at this point in time, my strategy right now is going to be look for the lowest IV in the chain on tech stocks and buy them up. Because, I mean, come on, man. 31.74. Oh, this is the wrong stock. This is A. Whoops. Let's put Apple. There we go. I was wondering, like, no volume for Apple? Okay, let's start do that over again. Okay, lowest IV's here. So for the 29th, though, FOMC, lowest IV's all the way out here. So it just keeps getting gradually more and more out of the money. That's the thing. It's like, I mean, put all your traditional thought aside and just look at this shit. This could be money right here, and the volume's there. The OI versus the volume today is very interesting. So I'm just saying, man, maybe worth a swing because, again, these Apple contracts for August 5th, this far out of the money, are, I mean, they're 15 cents, 9 cents. And they're not that far away from the price from a percentage standpoint. If we have some crazy day, I mean, that is, I mean, I don't know. You just gotta think about it. It's your own personal decision to make the bet, but holy shit, are we talking upside? Something's going on here. And based on research, institutional ownership, all these ETFs, remember, this phenomenon is not supposed to happen in individual stocks. It's only been visualized, for the most part, in index tickers like the SPY and VIX and things like that. But the fact that they're showing up in individual stocks only takes the research further that it's because of the interfund lending with the ETFs. It's because of the high institutional ownership across the board. And you know, you just got to look at this shit. And the IV's lowest that far out of the money, looking at the chart, everyone's on the wrong time frame. Look at the weekly. There is plenty of room for this thing to go up. And again, keep in mind, for some of these tickers, like Microsoft, let's look at Microsoft real quick. The RSI hasn't been this low on the weekly. Like on this point here, the last time we hit that low was 2010. So just keep putting all the factors in there, but that looks like a giant ass bull flag to me. So, remember, we don't crash, we just reset. And this last one just happened to be a soft landing, because look, this one was not soft, and we were still overbought after this theoretically crashed. Here, we went down, we only got the fair value on the RSI. Here, it was a soft landing. Real long and soft slope down. And ready to go back up now, so go long, baby. No, not financial advice.